Did we just suffer the beginning of a Wall Street crash after 3 months of gains, which had everybody euphoric? Today, we'll be talking about Jerome Powell and the FOMC and why what he said can be taken any one of two ways. We'll also be talking about the bond market. There's a clear dislocation happening because after Jerome Powell's statements, you'd expect yields to rise, except they took a massive dump. So is this really something to be concerned about, or will dip buyers step in and continue the all-time high fever? Hello, ladies and gentlemen. Welcome to the Daily Recap Show where we talk about stocks and the financial markets. My name is Chase. We do these videos every single day. So if you like these videos, hit subscribe, hit that notification bell and like this video. Let's get into it. You know, it's days like these that are quite sobering for the market. We just get a bit of a reality check that sometimes the market can go down, red everywhere, particularly in technology. They took the worst of it. Google down 7.35%. Momentum brings momentum to the upside, so too to the downside. But energy, really rough day. Healthcare, not too bad. I guess people getting a bit defensive, you could say, but there were sectors that were really green. Medical devices was all right. I think Stryker reported earnings and they did pretty good, but diagnostics didn't do so well. All in all, a really rough day for the market, particularly for small cap. The small cap index IWM dropped 2.4%, and it was small caps across the board: growth, value, quality, a blend of both, all three. Rough day for the market, including Nasdaq, S&P 500. The broader market held in there. I think a lot of that had to do with some of the flows we saw in healthcare. Novo Nordisk reported earnings, great earnings, increased their dividend by 60%. By the way, growth. It was a beat and raise on guidance, so they produced really good earnings. We had the situation with bonds. We're going to talk about that a little later, but overall, we're also going to talk about what happened right here. See this huge spike, like a 1% spike in the market? We're going to talk about why that is. Let's actually just have a look at the sectors on the day. Regional banks took an actual beating. The best performing sector, still negative, healthcare though. Other than that, markets that underperformed the SPY: discretionary, energy, technology, comm services, software. They underperformed the SPY. So yeah, rate sensitive names, not a good look for them. Semiconductors, I mean, that's still negative 1.44%, so a rough first day of January. And the last day of January in the last 4 years has actually been quite volatile. We've seen pretty serious gains, 22, 23, or very negative returns, 21 and 20 on the last day of January. So quite volatile. And the S&P 500 just following that trend down 1.61%, something like that. Now, let's zoom out. Look at the big picture. The month of January. What happened? Who were the winners? Who were the losers? GDX, regional banks, real estate. They were the real losers this month. Who were the real winners? Semiconductors, communication services, technology, financials. At the end of the day, for those of you that took my advice at the start of January, I said I gave you a bunch of stocks to invest in, and I said the sectors you want to be in is technology. This right here, okay? Software, XLK, semiconductors. That's what I told you guys. Financials, healthcare. It's exactly what I said you want to be in at the start of the month. And on my Twitter sometime today, I'm going to tell you what sectors you want to be in for February. All in all, you zoom out, technology was the winner. Okay, technology, healthcare, financials, those were the winners. And then technology proxies, comm services, software. All right, sometimes you just got to zoom out. Even though today was red, look at the big picture. Look at your portfolio. My portfolio is up like 7% this month. So sometimes zoom out and realize what you've actually gained versus what you lost in the near term. That being said, the QQQ declined more than 1.5% today, and every time that's happened on FOMC decision day, it has not really been good for returns looking 1 month out. This return has happened about 19-20 times. You can see right here the returns, the subsequent returns the next day, 3 days, 1 week, 2 weeks, 1 month. And on average, you could see that normally we get a bit of a relief rally 1 day later, 3 days later. But normally 1 week, 2 weeks, and 1 month later, we actually have negative average returns. Positive only about 40 to 50% of the time across all segments. And the risk to reward is not quite there. So all in all, we are probably looking at a February that's going to be quite volatile, quite choppy. It's going to be up and down. So do expect some volatility, but that's coming off the fact that between October to right now, indices have rallied 18%, individual stocks probably like 30%. Now let's talk about Jerome Powell. And he said so many things today. So Jerome Powell flip-flopped today, and it was really weird to me because the market thought, I think the market were expecting him to come out and say, we know annualized data is below the 2% mark, so we're going to cut sooner rather than later. No, that's not the case. I told you guys yesterday he was going to come out hawkish, because if he came out on a neutral stance, that's de facto dovish. Jerome Powell left himself in the committee room to see all the data up until March. He took the March rate cut off the table, but anything can change change between now and then. And he particularly had an emphasis on employment data. He said we're going to see what happens with employment as well as inflation. This was his statement. They ran so much back after his initial statement. You guys, I'm not going to read this to you. You can go ahead and read it. But the biggest thing here is the committee does not expect it'll be appropriate to cut until it has gained greater confidence that inflation is moving sustainably below 2%. And he doesn't want just like a touch into the 2%. He wants it sustainably below the 2% mark. And he said that the committee will continue right here to reduce its holdings of treasury security. So there's still balance sheet runoff continues at the moment. The big thing to take away from this is that Jerome Powell just left himself, the Fed, the FOMC committee, they just left themselves flexibility leading up to March to have a look at the data, and they're still going to remain data dependent. To be honest, this is exactly what I expected. It's just the market didn't like the fact that he took the March cuts completely off the table. Anything can change up until then, and the market's reaction was kind of crazy. People say the market overreacted. No, the market didn't overreact. The market is always correct. The market did exactly what the market wanted to do. And I think part of the reason why Jerome Powell came out and did what he did was because stuff like the labor market, certain data is pointing in many directions. Look at non-farms, the household survey, ASM services, and then JOLTS. It's just pointing all over the place. And what the Fed wanted to do is just remain flexible in seeing where this trend will continue. Are we going to continue sort of this downward trend, or are we starting to see a rebound with non-farms and maybe manufacturing as a whole? What did that do for rate cuts in the future? It totally took March off the table. 36% chance of a potential cut in March, a 25 basis point cut, 64% chance we hold for the moment. And it looks like the first cut is probably coming in May. There's a 58% chance of the first cut in May. And a lot of the market was pricing in cuts in March, and that's why we're having the reaction we did today. But let's actually have a look at what Jerome Powell did. So right here today, at the start of today, we got employment data, very soft employment data. ADP reports came in at 107. The market was expecting like 143 or 153, something like that. And the stock market opens and NYCB Bank down 40%. We're going to talk about them later, right? And at this point, the market thinks, oh yeah, March cuts for sure. Then leading up into FOMC, Jerome Powell releases his statements, and then we get quite a bit of volatility. The press conference starts, right? And right here at this point, Jerome Powell said some very contradicting stuff. He said stuff like the data was pointing in the right direction, something along those lines. And the market reacted very, very quickly. Then we saw that huge 1% rally. I'll show you on the charts. And then when he said March cut is not the base case, immediately May cuts, reaction, complete opposite direction, almost a direct reversal. So right here, 48.80, okay, 48.75 to like 49.05. That's a 40-point move. That's like 0.9%. At this point right here, Jerome Powell said the data is moving in the right direction. We get this rally. Then right here, he goes, March cut's not the base case. Absolute dump, okay? So as all in all, I mean, we did gap down, but like if we actually look at trade on the day, excluding the gap, market was slightly above the open, and then we just absolutely dumped after what Jerome Powell said, March cuts are not the base case. So there was a lot of moving parts, and that's why we got this very, very volatile action in the markets today. And Goldman updated their view, pushed the first cut back to May, but still expects 5 cuts in total. So 4 consecutive cuts at 25 basis points in May, June, July, September 2024, and then 25 basis point cuts every other meeting, once per quarter, all the way to 3.25 to 3.5%. Now, just to give you guys some data, normally what happens after a cut, this is non-recession, recession excluding COVID, and then the full sample. So in general, what normally happens is rate cuts are normally super, super bullish. And that's why we had a very negative reaction, because market cuts got pushed out further. We were expecting March. We're now looking at May, maybe June, that time period. Normally we get this massive run, but up until we actually get the first cut, the markets tend to be very volatile, tend to be very choppy. And that's why we reacted the way we did. And there were a lot of moving parts. Look at the 10-year. Now, very weird action in the 10-year. I mean, the 10-year absolutely dumped. And that's because Jerome Powell said something. He said there will definitely be cuts in 2024. So it may not be March, it may not be May, it may not be June, but it's gonna definitely happen in 2024. And that's why I think bond yields moved significantly lower, and bonds were bid up. It was really the first confirmation we got from Jerome Powell, from the Fed, saying, hey, there's definitely cuts going to happen in 2024. So that's why I think the 10-year was down significantly up in aftermarket, but yeah, still down as a whole on the day. Even though yields were down significantly, bonds rallied, stocks were still down in the actual dumps, especially technology. Let's talk about NYCB, New York Community Bank Corp, and down 37% on the day. It was some crazy price action. action. They were down like 17% pre-market, down 37% today, up a little bit in after hours, but brutal price action. And have a look at this PE right here, 1.62. I think this company does like $3.35 earnings per share. It lost like I think 40 cents in earnings per share this quarter. But yeah, you're literally buying this stock at EPS value. It's kind of crazy. But the reason why they actually dumped had to do with their earnings report, right? So what NYCB did was they bought Signature Bank last year in March after the whole SVB situation, right? So they took on all of their assets, all of their loans, all of their liabilities. And essentially what that did for NYCB was move it into a new size category for regulation. That requires the bank to take extra steps to build a stronger capital base. Pretty much to do that, they had to slash the dividend, build out credit loss provisions. They also spoke about some of their commercial real estate, having to build provisions for CRE division. And the market didn't like the fact that, their dividend was getting cut, credit loss provisions down 35% for the day, something like that. Absolutely crazy price action when you think about it. Regionals took a dump as a whole, but from everything that I could see, guys, this was exclusively just related to NYCB. It had nothing to do with what regionals were doing as a whole, but we'll have to see how this plays out over the next day. But for those deep value investors, this is probably somewhere you actually want to look at. I mean, the stock's at a 1.6 PE and management said that their financial health is quite strong. Yeah, they lost earnings per share this quarter, but I think it was the first time in years that it actually happened. So for those that are looking for a deep value stock, go have a look at, NYCB. It's not a buy or sell recommendation. I'm just saying that you're essentially getting a company, right, that stock price is probably trading below its book value, which is nuts. Just absolutely nuts, trading below book value. But anyway, let's move on, guys. Earnings. There wasn't much in terms of earnings. By the way, we did get MasterCard. They were up on the day when the broader market took an actual dump. I haven't looked at QCOM's earnings, but I think they did a pretty good job. They were green for the day, but tomorrow is a big one. We got MO. A lot of dividend investors hold this stock, these dividend growth investors. SiriusXM, that's one of Buffett's biggest holdings. He recently took a position in SiriusXM. Honeywell's reporting, Tractor Supply Company, and then we got the big ones after market hours, Meta, Amazon, Apple. This is going to be big for earnings per share growth to see what technology is going to do looking at the rest of 2024. So big day, especially Apple. And there was like some reports I was reading on the iPhone saying that iPhone sales are not looking good based on what chips they were buying from certain competitors. We could see something like year-over-year growth in iPhone sales, negative 15%. I've heard it all before. I'd want to see what Apple says on their earnings call before doing anything rash. And, I wouldn't buy into any news or rumors. Let's just wait for the call and see what they say about iPhone sales in 2024. But yeah, rumors I'm hearing around the mill. Something about earnings, guys. We got BofA's consolidated earnings, and this is what they say. Q4 earnings reported so far were negative 5% below expectations. This negative surprise was entirely due to financials. Excluding financials, earnings was actually positive, plus 5.3%. Financials really letting us down, and both the big names and regionals, yet they're rallying. Crazy when you think about it. The market is looking out to 2025, 2026 earnings, which is looking really good for financials. Blockbuster growth, I believe. February seasonality. Do we follow this? Maybe. We have the first trading day of February tomorrow. Normally we rise into the middle of February, not by a lot, only by about 0.5%, and then we actually dump after OPEX. This is normally OPEX into the March period, and we normally do finish February on a negative basis. Again, this is from 1950 to 2023, and the last 20 years given a greater weight. Now, let's have a look at some stats right here. So I want to bring out the big picture to you guys. Yeah, today was rough. A lot of investors shaking, but we need to remain constructively bullish as a whole, because when the prior year was down 15% in January, so when the prior year was greater than 15%, and we've had a positive January was up 1.15% in the S&P 500. So positive January, guys, this is what we can expect. So when January return was greater than 0%, we can normally see a financial year return in the positive 92% of the time. Return on average 16.3%. That's when the prior year was 15% or more. You look at this as a whole, the first half return 8.9%, second half return 6.5%. This is what's really interesting. On average, January is normally returns 2.7%, February 0.6%, March 0.8%, April 0.9%. So essentially what that says is we've had a strong prior year, we have a stellar January, and then we sort of have like consolidation year, March, February, April. And then the end of the first half and the second half is what normally gets most of these returns. So what does that mean for us as investors? We're going to be looking for dip buying opportunities in these sectors we think are going to outperform in the second half of 2024 as well as 25, 26. Okay, so I want you guys to follow me because I'm going to show you exactly what sectors to invest into. And I've told you guys, January I told you what sectors to invest into. I'm going to tell you what to invest in February as well, my Twitter. And I told you guys in December and November what you should be doing. And we've produced so much alpha in this community and I'm so grateful for each and every single one of you. But let's continue. Now, something I'm seeing in the tape, guys, the call gamma resistance has moved from 4,900 to 5,000. All right. And 4,800 continues to remain the negative gamma zone. So I really will get constructively bullish to the 4,500 area if we have a weekly close below 4,800. Until then, I do think that all dips are to be bought around that area, but we get below 4,800 and then we could probably look to 4,650 right here, 4,600, 4,500 in particular. Something we did see on the tape as well before open that was really glaring and probably foreshadowed what the day was going to look like was all of the negative gamma building in semiconductors. There was a ton of negative gamma building in semiconductors and spot price was actually below the gamma flip zone, and this was like a leading indicator to say, hey, we were going to have a really rough day today in the market, coupled with the fact that Jerome Powell was speaking, but that was the wild card. He literally could have said anything. If he was dovish, the market was going to rally regardless of what was on the tape. But that being said, this was a leading indicator and a great indicator to look at before the market opened. Now, let's have a look at some charts. I do want to spend some time on this. So look at this candle right here. Brutal candle. But it's happened before. It's happened right here. It's happened right here. It's happened right here. It's happened right here. Now, in the three other instances where this did happen, we did actually get a rally. The only difference between this area right here and this area right here was we're in positive gamma. We are still in positive gamma, but we go below that like 4,800 level, which is right here. We fall below this area right here. Okay, we're in negative gamma and we could definitely see something like this occur all the way to the 4,500 area right here, you know, the 46, 4,500 area. This will be a very good buy zone if we do get there. But that being said, let's wait out a couple of days. Let's wait out the rest of the week. Let's see where the weekly close happens because we got in positive gamma and we could see something like this, a bit of buy side support coming to the market, rally right above it towards the end of the week. It really depends. I mean, the truth is the market's going to digest what the Jerome Powell said. They're going to wake up tomorrow and they're going to say, hey, nothing has really effectively changed. I mean, the market wasn't even pricing in March rate cuts. It was 50-50 between a cut in March, a cut in May. And, you know, this was the reaction we got initially. But let's just let it play out first. There's no reason to short at the moment. There's no reason to get into shorts. Let's just let it play out. Now, I am hedged 10% of my portfolio. I did put that on my Twitter, like around here. I entered the hedge. I did enter the hedge sort of around this area right here. I put that on my Twitter. If you scroll down on my feed, you'll be able to see it. Maybe I'll put it up on the screen. But yeah, this is what we're doing. And, you know, I'm not going to look at adding to that hedge until we get below here and then see like further confirmation to the downside, because in all other instances, this right here was actually just a great dip buying opportunity for us to rally another 2 to 3%, you know, to the 4,900 to the 4,950 area here in the S&P 500. Now, looking at E-mini futures, we are slightly up after that. So, you know, we're up about 0.24%, bit of maybe shorts covering, you know, saying, hey, we make good profits for today. Maybe a bit of people buying the dip, but we'll see what this looks like at market, pre-market in the US. Now, looking at the Russell 2000, this is a multi-year resistance. Just 2 days ago, it looked like this right here. We were actually going to break it. But after today's trade, it looks like this is actually a very strong resistance area. And by the looks of everything right now, unless we conservatively break above here and then close above this high, there's no reason to be taking Russell 2000 longs right now. What you could say is that we probably look for Russell 2000 longs at this area right here. I mean, a lot of people are realizing that these companies are just not profitable. 40% of them are just not profitable. And this is why I advised all of you not to take Russell 2000 longs. I said, look at small cap quality. I've been saying that for the longest time. All of November, all of December, I said small cap quality is the way to go because there's great small cap names. Russell 2000, 40% of them aren't profitable. You don't want your money in this. You want your money in high quality growth companies, high return on equity, high return on invested capital. And that's what the market is telling us. We're seeing resistance right here. If we stay in this trend line longer, we're probably going to go lower and see like thin leadership. Now, dating the week ahead, guys, we had the FOMC decision today. Rough day for stocks. Tomorrow, we get initial jobless claims. We get non-farms, PMIs, ISM manufacturing, and yeah, that's it. Total vehicle sales too. That's all the data in the week ahead. And then on Friday, we're getting private payrolls, non-farms. We're getting sentiment, Michigan sentiment, and then average hourly earnings. So there's still a lot of data in the week ahead, guys. So stay safe out there, okay? And if you've made it up until here, thank you so much for watching. If you like this video, please subscribe. Hit that notification bell, guys. Like this video. Cheers.